We are recording. Hi everyone. I'm Amber Finch of Finch Real Estate Company, and I'm joined here with a friend and longtime mortgage partner, Mike Smalley of Waterstone Mortgage. Thank you so much for joining me today and allowing me to interview you with some questions that I'm sure are some burning questions from some people going on. A little bit about Mike and I. We've been working together since 2010. Mike helped me purchase my first home back in July of 2010, and he begged for my business prior to that because I was a buyer's agent for a foreclosure brokerage and kept knocking on my door for months, and finally I gave him a shot with my own mortgage, and he blew me away. So his staff and team together all work really well, and they provide excellent customer service, and they've helped me try to formulate how I want to do my business and make sure that I provide great customer service as well. So thank you for your mentorship in that, Mike. I appreciate that over the years.
Yeah, thanks for having me on.
Yeah, no problem. So tell me, I guess, how you got started in the mortgage business.
So I kind of grew up thinking I would be a financial planner. That's what my dad did, and that's kind of what I knew, and I thought that that's the path I would take. And but I didn't really think about my career much when I was a kid, because I was a pretty serious baseball player. I played in college at Florida State and Florida, which is a funny story how that happened. And I played in the minor leagues for a couple years with the Braves. So that was kind of my sole focus, when I was a kid. There we go. Bobby Lynn, I can go either way. Because I played at both, but I'm more of a Seminole fan. So go Knowles. But anyway, I got good grades and majored in finance, but wasn't sure what I wanted to do. I retired from baseball right before 9/11, and I was helping my dad that summer before I went back to my last year of college. And I met one of his top clients, who will remain nameless, but it was like his top client had the most money invested with him. And then 2 months later, 9/11 happens, and I'm talking to him one day, and he's just completely panicked and had just had the worst day ever. And I'm asking, well, what happened? I mean, obviously we knew any financial planner was having a tough time after 9/11, but what happened? And it was like, well, do you remember that client I introduced you to? They completely reamed me a new one today and just laid into me. And I was like, well, you didn't cause the stock market to crash. And they were mad at him because on September 11th, the market never opened. And then a week later when it opened, it was, down significantly, kind of like what's happening now. And so that made me realize that, if you're going to work with someone, you kind of want to work with someone who appreciates you and doesn't, talk down on you or belittle you or get mad at you for things that are out of your control. So quickly, that was no longer my career path. It was not going to be a financial planner. And I kind of fell into mortgages. I had a friend of a friend who was in the business, and I was getting out of school 6 months after 9/11. The economy was bad. There weren't a lot of jobs. So I took a 100% commission job as a loan officer in the summer of 2002, almost 18 years ago, and haven't looked back. So I always liked real estate. I knew I kind of wanted to be involved in real estate somehow, and I liked finance. The thing I like the best about this job is you get to help people, and when you help someone buy a house, they're generally excited. Unlike what I experienced with my dad when someone was mad at him for things he didn't control. So, still the most fun part of our job is, you take the difficult transaction, someone that maybe needed some coaching or guidance or help budgeting or help fixing their credit, and however long that takes, you get them to the closing table. It's still a pretty exciting thing all these years later.
Yeah. And occasionally we might get a few of those mad clients for things out of our control, but they're probably not as many as the financial industry.
Yeah. Well, and but even if something happens and someone's upset or frustrated or stressed because it's really stressful to buy a house, once you get to the closing table, everything's kind of good again, and you end the transaction typically on a positive thought.
Very true. Very true. So tell us a little bit about mortgage interest rates today.
Yeah, so thankfully in the last 2 weeks or so, things have stabilized. So pre-coronavirus rates were in the upper threes, and we expected that they were going to come down this year for a variety of reasons. As soon as this crisis hit, we saw a sharp drop in rates that lasted for about 13 seconds. It felt like it was probably about half a day, but a big drop in rates, followed by a big increase in rates. We went up to 4.25 really fast from like 3.25. And then we've kind of settled back down, and rates are kind of back into that low to mid threes range, and they're stable. Essentially what happened was when this crisis happened, there's fear, there's uncertainty, and people fear the unknown. And the secondary mortgage market was just completely out of whack and kind of acting irrationally. And the Federal Reserve stepped in and announced some programs that have stabilized things, and not only stabilized things in a sense that rates have come down, but stabilized things in a sense that less volatility. So we're on a slight downward slope in rates, which is a market that I love, but we're not on a roller coaster. And we were on a big roller coaster for a couple of weeks right when this started, like the last couple of weeks of March.
And I'm sure your phone blew up like crazy when they announced the 0% interest rates from the Federal Reserve. What does that?
Our phone, yes, yeah, our phone went crazy. But it's important for people to understand that the Fed funds rate is not mortgage rates. The Fed funds rate is a short-term rate that banks can borrow, money for overnight lending. At the Fed funds rates coming down, then generally interest rates and other things, longer-term things like cars and mortgages, will probably go down. But mortgage rates are typically about 3 to 3.5% over the Fed funds rate. So the 10-year Treasury is really what you should follow if you're looking to see what are mortgage rates doing. Truthfully, it's the trading of mortgage-backed securities, but that's kind of complicated and not really available to track unless you pay for a service to subscribe to it. But when you hear the talk of the 10-year Treasury going down, generally speaking, mortgage rates will probably go down as well.
Okay, cool. So with the coronavirus, I know a lot of different industries and businesses have been having to make some changes because of the crisis going on. Have you guys noticed any changes going on with the mortgage side?
Yeah, there's a lot of changes, and I think the best way to explain it is to kind of big picture explain how the overall mortgage market works, like the secondary mortgage market, if you will. So when someone gets the mortgage, there's three people involved. There's the originator, who is originating the loan. That would be someone like us, Wells Fargo, Quicken. There's the investor, that's who owns the loan, and most of us have no idea who the investor of our loan is. And it's typically Fannie Mae, Freddie Mac, FHA, government entities for the most part, that package all of our loans up together and sell them off as mortgage bonds, which then gets purchased by 401k plans, pension funds, mutual funds, things like that. So there's an originator who that's who you worked with. There's an investor. And then the third company is the servicer. And the servicer is who you make your payments to. And in some cases, the originator is also the servicer. But in some cases, it's not. And in some cases, your servicer might change, and it could change multiple times over the years. So for the past number of years, mortgage companies and banks have had a big appetite for buying the servicing of mortgages for two reasons. One is they figured it's not a risky investment. There's a lot of risk to servicers if someone's not making their mortgage payments, they're going in default. So with unemployment at all-time lows, default rates at all-time lows, there's not a lot of risk for servicers of someone defaulting because we're at historically low levels of that. And at the same time, servicers, they make money year over year when they service a mortgage. The longer the mortgage is serviced for, the more money they make. So many lenders and banks bought up a lot of servicing in the last couple of years because the default rate risk was low and interest rates were low. So if I bought the servicing of a 4% 30-year fixed rate mortgage, chances are that mortgage is probably going to be serviced for a long time. That person's probably never going to refinance, right? Given how low that rate was. In the last 30 days, the biggest change in the mortgage market is the complete collapse of the servicing market and the appetite for buying servicing. And that's for a number of reasons. So the first reason is with rates dropping, all of your existing servicers are having what's called prepayment speeds at all-time highs, which means if a bank services $100 million of mortgages, $50 million of that is probably refinancing right now, which means they're losing all that revenue. At the same time, they probably borrowed money to buy the servicing. So not only are they losing the servicing of all the loans that are refinancing, but now they have margin calls from the bank they borrowed money from. So an example would be, let's say you have a home equity line in your house, okay? Let's say you have a $100,000 home and you have an $80,000 home equity line. So you're at an 80% loan to value. Let's say the bank agrees that no matter what your home is worth, you can borrow 80% of it. So if your home goes up, you can borrow more. But if your home goes down, they're going to ask for cash. So let's say you're a servicer and you have a $100,000 house and an $80,000 loan. If the value of that house goes to $50,000, what has to happen to your loan? You have to pay that loan down from $80,000 to $40,000. So at the same time, all these servicers are losing their portfolio with people refinancing. They're also then getting hit with cash margin calls where they have to come up with cash to pay these loans down that they borrowed from to buy the servicing. So servicers are in a world of hurt right now. And to make matters worse, the biggest risk for servicers is default. And so what's going to happen if we go from 3.5% to 20% unemployment? You're going to have mortgages default. And when a servicer services a mortgage, so let's say, Amber, if you're servicing my mortgage, okay, and so Bobby Lynn, you're the investor, okay? So I make my payments to Amber. Amber forwards the money to Bobby Lynn. Well, if I don't make my payment to Amber, Amber still has to pay Bobby Lynn. The servicer still has to pay the investor. So now if I don't pay Amber, and if Rob, Nicole, Kristen, and Lee, who are also on this, don't pay Amber, how long can Amber afford to pay Bobby Lynn for the 5 mortgages that are defaulting? Not very long. So servicers have been crushed with margin calls and servicing payoffs and prepayments. They definitely don't want to buy more servicing for new loans because they're worried about, are me, are Kristen, or Lee, or Rob, or Nicole going to make the mortgage payments? Are we going to lose our job? Is there going to, and can you afford to pay Bobby Lynn, who's the investor? So the biggest change in the mortgage market is the servicing, the secondary market, the servicing of loans. There just isn't an appetite. So if I'm a servicer, I really have to look at, okay, what loans do I want to service? And I have to get really risk averse and very conservative. I still have to continue buying servicing because I have to continue bringing revenue in, but I have to get really picky on what loans I buy. So in the last 30 days, this has happened almost overnight. That's where you've seen minimum credit score requirements go up. So with FHA mortgages, we used to be able to do a 585. That went from 585 to 640 almost overnight.
Wow, that's a huge.
Max.
That cuts out a lot of potential buyers that were looking to buy FHA because most of them
potentially, yeah, potentially. So you have lower credit score stuff. You have the higher debt to income ratio. All the government loans like VA and FHA have been, and USDA have been impacted. Jumbo loans have been impacted. So the servicing space has gotten really conservative because they're getting hammered to begin with. They still have to buy servicing, so now they've got to be really conservative with what they buy. So the products we had available went from here, to here really quick. And I think it's going to get a little bit tighter before it gets looser personally. I think you'll see a little bit more tightening. And it's not the originator, it's not Waterstone or Wells Fargo or Quicken making those rules up. It's really the investor and the servicer who says we can't take the risk of these loans going bad. And it's happened really fast just because, we've got how quickly this is all unraveled, unemployment going from 4 to, who knows what it is, but, Janet Yellen, who's the former chairman of the Federal Reserve, was on TV the other day, and she said that she thinks real unemployment is probably about 12 or 13% right now. But that won't be reported for another 30 days because that's a very long lagging indicator. So we won't know what the true unemployment is in early April until probably the middle of May, even maybe an early part of June. Wow. So if you understand the servicing market, that helps maybe understand why some mortgage programs are going away. Good news, though, is that we can still do about 90% of what we could before, and the 10% that we can't do, we've just got to be more resourceful. We've got to help the person with a lower credit score, the person with a 619 credit score that before I didn't have to help them improve the score. I need to help them improve their score now. So maybe they're purchasing gets delayed 60 days while we help boost the credit score.
Yeah.
But not everything's gone away. You know, we can still do most of what we could before, but in the stuff that we can't do, we just have to be more resourceful. And it may take some time to get people in a position where they can get financing.
Well, speaking of credit scores, do you have any quick tips maybe that maybe some of our listeners could use just off, I mean, I know everybody's credit position is different, but just some things for them to keep in mind to help improve their credit?
Yeah, I mean, so when we talk to someone about credit repair, there's typically a few different types of people. There's someone that has a lack of credit, which we have to help build. There's some people that had an event, like maybe an illness or job loss, that we have to clean some stuff up. And then there's others that just have poor habits, right? So if someone has poor financial habits, that's not something any of us can fix. That's a personal, you know, that's something personally they're going to have to fix. But someone who has a lack of credit, that's an easy fix. There's things you can do like getting secured credit cards. You can get added to a family member or a spouse as an authorized user. So perfect example, I've got a young couple, and the wife has better credit than the husband because she has a little more extensive credit history. So it's actually like my wife and I are a perfect example. I didn't have a credit card in college, she did. So when we bought our first house, her credit score was like 30 points higher than mine because she had a couple more years of history on me. So in this example, the wife had, I think, a 740, the husband had a 690. So I said, well, you know, you need to get added to your wife's credit card as an authorized user because that'll give you and let you kind of piggyback off some of the good history she has. So getting added as authorized users, setting up a secured credit card, there's things you can do that can build credit. There's some utility companies now that if you request, they'll report utility payments, rent. I see some apartment complexes do that, where they'll report to the credit bureaus. So the person who has a lack of credit, that's an easy fix. It just takes a little time. It doesn't happen overnight. And then the person with some stuff from the past, when we pull somebody's credit, I try to identify what are things they can do. So paying credit card balances down to a lower percentage of the limit is one. This may seem counterintuitive, but raising the credit limit can help. So I had a client the other day that owed $3,000 on a card that had a limit of 4, so he owed 75%. And I really don't want him to spend $1,500, excuse me, paying his credit card down, because that's part of the money he needs for his down payment. So he went to his credit card company and asked to raise the limit, not to borrow it, not to use that money, but he was able to get his limit raised from 4,000 to 8,000. So now rather than owing 75%, he owes 37.5%. When I get the credit rescore done, which takes a couple of days, that's probably a 30-point swing he's going to see.
Nice.
And that could be 0.25% better in interest rate. A 30-point swing like that. So there's a lot of little stuff we can do that can help and tweak. When people ask me about helping with their credit, a lot of times they want to give us something they pulled on their own, like Credit Karma or their own report. Us or really any other lender, we can't do anything with that. I mean, I can look at it and say, hey, here's what I think I see, but until I've pulled my own, I really can't give you advice that I would say is accurate. And there's simulators, there's tools we can run that I can plug in and tell the credit bureau, I need 50 points or I need 20 points, what should I do? And the tools we have are pretty accurate, and it'll give me a pretty good idea of what needs to happen to get someone's score to a target range we need it to be in. But I can't do that unless I pull my own.
Now, are you charging for any of this credit repair stuff, or do you kind of just do it if they're planning to?
No, we don't charge, and we're not allowed to. I mean, our company doesn't let us, and we wouldn't. And I don't think mortgage companies in general, I'm not sure if anybody really does or can.
Yeah, but it seems like you guys do a little bit more intensive in the background of their credit score and giving the advice and then doing a rapid rescore, which is really useful.
Yeah. I'd like to do it rather than sending them to a third-party company, because if I do it, it's going to save them a bunch of money, and I have more control over it. If we send them off to some third-party company, my experience, and I can't speak for all of them, is they just want to charge you $200 a month and drag it on as long as possible. Okay. So like my goal is to get it improved as fast as possible so you can qualify for a mortgage, where those companies, I think, goal is to drag it out so they can make more money. So I think the the customer and the credit repair company's goals aren't always necessarily congruent with each other.
That makes sense. I've had some people have some issues before with credit repair companies. And so I always try to come to you first because I'm like, they'll give you advice. I promise you, they want to sell you a mortgage. They want to get your interest rate up. So they have, I guess reasons to be able to help you. So.
Yep.
All right. So stemming from there, what about somebody that currently owns a home already and they're struggling to make their mortgage payment now with everything that's going on? I know they've been hearing talks of mortgage forbearance. Can you tell us a little bit more about that and why someone might consider doing it, maybe what the process might be?
Yeah, so I just actually did a video on this and emailed it to my past clients today because it's so timely and it's a hot topic in the media, amongst friends, social media. There's a lot of information out there. I think a lot of it is not necessarily bad information, but maybe doesn't give all the details. So forbearance should only be used if someone truly can't make their mortgage payment. Like if you can make your mortgage payment, keep making your mortgage payment because forbearance will have other consequences. So it's not like hey, I'm just going to skip 3 months and then pick up in month 4. If you can afford to make your mortgage payment, continue doing so. Don't stop. Don't go into forbearance. And a lot of the reason behind that is we don't know what some of the impact will be. The government said, nobody has to make a payment for 90 days, or they put out these programs, but the impact of that is still very much unknown. If too many people go into forbearance, you're going to see mortgage servicers going bankrupt left and right, like in the example I talked about earlier, which would be even more crippling for the economy. And it differs if it's an FHA mortgage or if it's a conventional. But and there's a lot of things on Facebook that some of you have probably already seen. But an example of forbearance would be my payment's $1,500 a month, and I don't have to make a payment for 90 days. That's pretty common. The question then will be, what happens after day 90? Do I just pick up and go back to $1,500 a month? And do they stick that 3 months on the end? The answer in many cases is no. The answer in many cases is in month 4, you owe me $6,000. You owe me the 3 months you missed and then the current month's payment. And so for someone who needs help financially to get through this time, can they afford to spend $6,000 in 4 months? No. If they can't afford the $1,500 payment today, they certainly can't afford to write a check for $6,000 in 4 months. So sometimes there's some unintended consequences. It might get worse. And then in 4 months, you call the servicer and say, hey, we can't pay $6,000. So then the servicer might say, okay, well, you can pay us the $1,500 a month, but you need to pay back the $4,500 you owed us over the next 3 months. So you owe us $2,400 a month for the next 3 months. And the homeowner's like, well, I can't afford that either. So I just think it's important that if someone does need the help, if there's a reduction in income, loss of job, and it's put food on the table or pay my mortgage, you need to pick the phone up and call your servicer and ask about it. But make sure you double and triple and quadruple check, because the last thing someone would want is to think that they got into a program that can help and then have it dig a deeper hole in a few months. And don't just stop making payments. Like we've had people tell us, well, the government said I had 90 days off, so I'm just not going to pay. It's like, no. Any creditor, whether it's a credit card, car loan, mortgage, whatever, if you're worried about having trouble making the payments, the best thing you can do is call them. Don't just stop making payments. So some of these programs will work, but it's going to be different depending on the loan you have. And I would encourage people, who have that type of situation, have that need, look at all the other alternatives that are in the stimulus package. Look at the increased unemployment and the kind of tax refund type checks that everyone's going to be getting. Like, look at that stuff first to see if that can help cover your gap if you're out of work or have reduced hours for a period of time. But forbearance is just kind of one of the tools in one of the arrows in the quiver, if you will. Like, it's an option, but there's some others as well. But before you do it, just make sure you really understand it.
That's really good advice, Mike. Thank you for addressing that. I also heard similar things about the people thinking that they don't need to pay rent, thinking that they just get to skip a few months and not make the payment, when the landlord is going to come back at the end of those few months and say, well, now you owe me for all these months that you didn't pay me.
Right.
be.
Well, and I mean, it's the same thing. Like Amber, if you're my landlord and I rent from you and I can't afford to pay you rent, well, you probably still have a mortgage you got to pay, and that mortgage servicer has to pay the investor. So the best thing that I can do is I can, hey Amber, I'm struggling. You're my landlord. Can you help me out? You know, and I've heard from a number of people who have gone to their landlords and said, hey, you know, can you help me out a little bit? And I mean, I've had like professionals, like people that, you know, you wouldn't think needed the help, but I mean, it can happen quick. I know a dentist that is, you know, like, hey, I might have to call my landlord. I'm, you know, tried to pay my staff, you know, running through cash like crazy. I don't know when we're going to open back up. And so my advice to anyone like that is whether you have a mortgage or you're renting, call your mortgage company or call your landlord. I think the landlord would rather say, you know, pay me $500 versus 1,200 if that's what you can afford. You know, I mean, you know, mortgage companies don't want to foreclose and landlords don't want to evict people, especially right now. So
Yeah.
yeah, just, yeah, make the phone call and ask.
And then that landlord that has a mortgage could potentially go do forbearance, and you know, while they're
Yeah,
waiting for their tenant to be making their
right.
payment, hopefully they don't do it without, you know, the tenants
Yeah,
still making their payments and they still decide to do the forbearance, because I would say that that would
yeah.
be useless.
But I think on the forbearance topic, you know, there's a lot of unknown. There's a big lender, Caliber Home Loans. They're a nationwide lender. They service a lot of mortgages. Their CEO was on CNBC last week and said they got 80,000 calls in one day to their servicing department. Not necessarily applying for forbearance, just asking. You know, like what is it? What does it mean? So you know, they're overloaded with it. So you know, I would imagine if someone's calling for that, they're probably going to be sitting on hold for a while. And I would go to their website, try to do the research. Most servicers probably have something online that talks about what their program or plan is.
Yeah.
Um,
Okay. So on that kind of topic of somebody struggling in this circumstances right now, if they've been laid off or furloughed, how would that affect somebody's ability to purchase a house right now, or maybe refinance? Do you foresee how that's going to change in the future?
yeah. So you know, our staff struggles with this a little bit because I think sometimes people, like internally, I've told our team, like, you know, we're overcomplicating this. So if someone, if I know someone is losing their job or quitting their job at the end of the month, then I can't use that person's income to qualify because I know that that income is not going to continue. And so if we go pre-coronavirus, if I have a client working for Disney and they're closing December 31st and I know January 3rd is their last day of work, I can't use that income, period, unless I, you know, have an offer letter of where, you know, what new job they're getting, then it's different. But if they're just stopping working, period, and that's not going to continue, we can't use their income. And so internally, you know, we keep thinking about, well, how does this impact that impact? It's the same way with, you know, kind of post-coronavirus. If someone is losing their income, then lenders, and this is not our rule, this is the government, Fannie Mae, Freddie Mac's rules, we can't use the income for somebody's furloughed. So we have a big stack of Disney employees right now that are kind of on hold, and Universal, and there's all kinds of people that are furloughed that haven't lost their job, but they're not getting paid, that are just kind of sitting, you know, wondering like what's next. And so some of those people have canceled transactions. We've seen that when they've lost their job. Personally, I can't blame them. I'm not sure if I'd want to buy a new home if I was uncertain of my income and employment, but some of them have wanted to continue. And so I mentioned the word resourceful earlier. I had a client who worked in the kind of the tourism area and who was laid off, but the husband's income was enough to kind of make the deal work, and they really wanted to buy the house, and she feels comfortable that she's going to be back to work in 60 to 90 days. So they made the decision that, okay, we got enough savings. We think we can live off his income. We've been looking for 3 months. This is like the best house. This is the one. So they're still closing. And we kind of had to get resourceful and figure out how to make it work with one income. And we're running into that a lot. We're running into more of people who are having a reduction in income. And I ran into that yesterday. I had a client who was supposed to close yesterday, and earlier this week, So let me back up. The new rule is that lenders have to verify 3 days before closing or less that you're still employed, you're still getting the same number of hours, and that you're not getting furloughed. And there's a questionnaire we've got to fill out. We've got to ask their HR like 4 questions. So this person's not losing their job. Their company decided rather than laying off people that they're just going to ask everyone to take a 30% pay cut until they can get through this. Well, this person's 30% pay cut, income's now not enough to qualify. So we're trying to get resourceful and creative. I think there's a decent chance it'll close, but the seller is going to have to contribute some cash to cover closing costs that they weren't previously contributing, because this person now has to pay off a car loan in order to qualify because their income's less, so their debt has to be less. But I think the seller is willing to do that because would they rather take $5,000 less on a $260,000 house today and close, or lose this contract and then you kind of go into the unknown? It's kind of like what's the bird in the hand, saying. I think they'd rather have this surety of just being done with it. So I think that one may work itself out. But the biggest challenge for us is the reduction of income, because some people, we just don't know how many hours they're working or when it's going to go back. And they don't either, which is tough.
Yeah, so with that, that's what's kind of going on currently. And I know it's hard for you to know for sure, but what is your expert, experience, opinion on what might happen in the future? Let's just say a year from now or 6 months from now, people are back to work like normal and they're wanting to buy a house, but there's a break of income because of these layoffs and furloughs. Do you think the mortgage might take all into consideration, or?
So I think some of the programs that have tightened up, I don't think are going to come back anytime soon, like the lower credit score stuff. I just think it's going to be a while. It's like, so there's like 8 or 9 of us on this live right now. Which of us is going to be the first to go to the movies? I'm not sure if I'm going to be the first. Like, I'll let you guys go first and make sure it's safe.
Yeah.
And, you go, you tell me it's safe, and then I'll, go 2 weeks after I know, that, you were quarantined and you're fine, right? So you and Charlie go to the movies, Amber, and tell me when it's good, And so I think mortgage companies are going to do the same thing, they're going to be conservative bringing back some of those programs, and nobody's going to want to be the first. So it'll be kind of a slow, recovery with that. And then as far as like how I think it affects home prices, and so the Federal Reserve is going to keep rates down. They've announced something called quantitative easing, or QE, which essentially means they're buying assets, and the assets they're buying is mortgage and treasury bonds, and that's a way for them to keep rates lower. So the Fed can lower the Fed funds rate, which is short-term borrowing. They can't directly lower mortgage rates, but they can if they buy mortgage bonds. So the Fed announced something that the media is calling QE infinity as a kind of a joke, which means their Fed said they're going to buy mortgage bonds for basically as long as it takes and as much as it takes to keep rates low. So we think rates will be low. We think we're going to, stay in that range we're in now for some period of time. Like, I think you're going to see low rates for pretty much all year. As far as when things rebound, like we can talk about home values, I think there's a big qualifier with the market. When do we get back to work? So if we're kind of getting back to work, or back to normal sometime between like May 1st and June 1st, then I think it's going to rebound pretty quickly. If we're still dealing with, stay at home and, we're doing Zoom meetings every day and we can't leave our house, and, we spend 15 minutes disinfecting our groceries, before we come in the house, like I'm doing, so guilty as charged. If we're doing that August 1st, like, I think it's a whole different story, because this is going to last longer. But a lot of people wonder what's going to happen to home prices, and they want to compare this to 2008. I don't think this crash has anything to do with 2008. I think they're completely different. This is much more like September 11th. In 2008, the real estate market caused that crash. Liar loans, exotic mortgages, adjustables, people not getting what they understood, people buying houses they couldn't afford and not thinking about, can I actually make the payment? Greed amongst buyers, lenders, realtors, appraisers, everybody. That market was just a massive bubble getting ready to burst, ripe with fraud and abuse. And that bubble burst and took the whole economy down. The real estate market's great right now. Interest rates are low. People who have mortgages all documented their income and have low rate fixed rates. So it's a much different market than that was. Nationwide, there was 8 months of supply before the crash in 2008. Now there's 3 months of supply. If you made the median, if you made the median income and you bought a median priced home in 2008, your mortgage payment was 25% of your income. Today it's 14%. In 2008, rates were 6.5 to 6.75. Now they're 3.25 to 3.5. So there's a lot of things that make the real estate market much more stable today. I think this is a lot like 9/11, which is something that kind of blindsided us, came out of nowhere, completely crippled the economy really fast out of nowhere, like a good economy, and then led to a lot of fear. I mean, after 9/11, I didn't want to fly. I was talking to my partner, Dustin Amber, and he and our other partner, David, we flew to New York. No, we flew to Milwaukee, where our corporate office is, in like 2009 or 10 on September 11th. And we didn't realize it at the time, but we flew on 9/11 because we had a meeting up there. And it was really weird, and we were all really kind of just a little bit on edge flying a 9/11, even 7 years later. And every September, we fly there every September for a meeting. I've flown on 9/11 like 3 or 4 more times since then, and I don't really think about it, and I don't notice anything different in the airport, and it's kind of back to normal. But it took about 7 years before like I was comfortable flying on around that time of the year. And but nobody, like, I remember after 9/11, people were wondering, like, should I go to Disney, or is there going to be a terrorist attack? And there was just fear of kind of getting back back out there. So I think what we're experiencing now is a lot like that, which is like fear and uncertainty. Back then, once enough time passed and we realized like we were safe, we were protected, there weren't other terrorist attacks happening, then people kind of got back to normal. And so when we realized that we're safe, we're not going to get sick, we can go see people, we can have face-to-face meetings, whenever that happens, then we can get back to normal. So the quicker that happens, the better. The better we do with the whole stay-at-home social distancing, and the faster we can get back to normal, I think the faster the economy will rebound.
Yeah.
And hopefully that happens hopefully in the next 30 days. We're seeing good positive signs, and that'll, I think, get us back to normal faster. But if we're talking August 1st and we're still doing Zoom meetings like this, then that worries me a little bit.
Oh yeah, I can agree with that. And I also, since we're talking about the real estate market, I also know that there's going to be a lot of pent up demand. So there's several,
Right.
sellers that took their houses off the market because they're afraid of people going in their homes. There's buyers that put it on hold because they're like, look, we really don't need to buy right now. Let's wait and see. And so when we do get the all clear, or we start to get more comfortable with things, I think we're just going to have a flood of both buyers and sellers onto the market again, and give us a market.
I've told our team, the analogy I use is, I think the month between Thanksgiving and New Year's is always kind of quiet in real estate. There's a lot of closings because those contracts were written earlier, but there's not many new homes going on the market, and there's not many new contracts written in December. It's kind of a quiet month. In January is typically always the slowest month of the year for closings, but January flip-flops it. All that pent-up demand starts to boom, and listings start to hit the market, and new buyers start to hit the market. So I think the month of April is going to kind of be like the month between Thanksgiving and New Year's, where people are still closing, and we have a lot of closings this month, but there's not going to be as much new stuff. But when we get the all clear, it'll be like January again, which is like everyone kind of comes back out in that pent up demand.
Yeah.
And in Florida, I mean, it seems like every year we have a bad hurricane, or at least, I think we probably had one every 2 or 3 years, but when we run through those hurricanes, that's a 2 or 3 week period of time, because it's like a 10-day period of time where you start to watch it, and then the cone kind of puts us in the center of the cone, and for a week beforehand, everyone's hunkering down, and then for a week or two for us in real estate after, there's not as much going on because we're having to reinspect properties and reappraise properties and things. So we've been through stuff like this before. If anywhere is equipped to handle it, it's Florida.
That's
you
true.
know, because we've been through the crash as bad as anybody and got through it, and we've been through all these hurricanes and got through it. So if anybody can handle it, it's us.
Yeah, I could agree with that.
Yeah, we have the experience, unfortunately.
So we got about 15 minutes or so left, and I wanted to open it up to anybody that's on the call that would like to ask any questions. Anybody have anything left over? If you do, you can either unmute yourself or wave at the camera. I'll unmute you. All right, so I actually am, since we're waiting, maybe it'll jog people's memories. Or if you're just listening in and you want to type in a chat, I'll open up that chat window as well and look for questions. But I'm currently refinancing my loan with Mike. And I think that, you know, the low interest rates have piqued up people's interest in, you know, possibly refinancing. And since the mortgage rate is so low for people, is there, you know, reasons why it would be a good, you know, what are the reasons why people refinance? What might cause them to want to refinance?
So to me, there's three types. So one type of refinance is if someone reduces their payment. So I'm just looking to save payment, and to determine if that makes sense or not, you just need to look at what are the closing costs, what does it save me, and what's my break-even period of time. And I'd like that to be less than 18 to 24 months. I think if you're gonna plan on selling your house within 2 years, you don't need a refinance because you're not going to earn back the closing cost. A second kind would be reducing the term, which has gotten pretty popular. So let's say you're 4 years into a 30-year mortgage at, let's say, 4.5%. We've had people drop that to low threes on a 20-year. Keep the payment about the same, but knock off 6-7 years of term. So there's benefits to that. And you can always no mortgages anymore have a prepayment penalty. So someone could do a 30-year mortgage and they could pay it off in 20 years if they want to. So I talked to someone the other day, and they decided they would prefer to do the 30-year just for flexibility. A little bit worried about their job and income and stuff, and just they figured let's have the lower minimum payment, but we're going to plan on paying it off faster. So those are the two most common types. There's a third type of refinancing that I hesitate a little bit to talk about, but it's if someone's pulling equity out of their property. And the reason why I hesitate to say that is because I think that was abused and caused lots of problems before the last crash, and people were pulling equity out and using it for like unsound choices, like taking vacations to Hawaii and stuff. So if someone's pulling cash out, there can be a benefit if you're paying off other higher rate debt. I had a client the other day. She had some credit card debt, and it was like really high rate, high payment. And when we compared what her current mortgage and her current minimum credit card payments were compared to what the new mortgage was, her mortgage was going to be about the same, but the credit card debt was like $700 a month. So cash flow wise overall, she's saving about $700. So, but my recommendation to her was, that's great, that we can save you $700, but don't just blow that $700 a month and increase your lifestyle. Use that $700 to do something. So, make sure you're maxing out your 401k, or apply it to the principal of your mortgage and, make a larger mortgage payment. But so, she's going to do a little bit of each. Her plan was to put an extra $350 a month in her retirement account, and then put $350 a month extra towards the principal, and just set it up on automatic payment so she wasn't tempted to make the lower payment. So cash out refinancing can benefit people, but you got to be smart about it.
Good. All right. Well, let's see. Bobby Lynn says Mike really hit all the areas of her concern. She has 2 rental units that are on an arm, an adjustable rate mortgage. Yep. Can she see those rates fluctuate this year?
So, Bobby, that's a great question. I'm not an anti-adjustable rate mortgage person. I haven't done one. I mean, I might do one a year. And the reason for that is right now there's not much of a spread between fixed rates and adjustables. And with fixed rates so low, rates on arms just aren't better. So like they might have been years ago. So, but if they were, like if a fixed rate was at 3 and a 7-year ARM was at 2, and someone was going to keep their home for 5 to 6 years, I wouldn't hesitate to recommend that to that person if they, understood exactly how that program worked. I have a rental property that I did an ARM on in 2005, and it's been adjusting since 2010, and it's been pretty awesome because for 10 years my rate's been below 3.25, because we've been in a long period of low rate environment. So your rate's probably really low on that, probably below 4. With the Fed cutting the Fed funds rate, that rate's probably going to go down. I would make sure you watch for the letters you're going to get in the mail that talk about rate changes, or maybe go online and look at your statements. I don't have I don't have a problem with someone keeping an adjustable for a long period of time. Like that might be the best mortgage for you now, and it might be the best mortgage for you for many, many years, depending on how long you're going to keep that property for. I think it's just anybody who has an adjustable, you just need to you need to understand it and keep a close eye on it. And most of them adjust once a year, and just watch it. But I've had mine's been adjusting for 10 years, and if I was to keep that property for another 10 years, I might consider refinancing it in a couple years if I felt like rates were going to start going up. But my advice on those is just take it year by year.
Now, doesn't adjustable rates, aren't they like 3-1, 5-1, 10-1? So wouldn't it also matter if she has, that period of time coming to an end?
5-1.
Yeah, but is yours already adjusting?
Yes, but in my favor.
Right. So she had a 5. Yeah. So she had a 5-1 that's past the first 5 years and adjusting every year. Yeah. And most people who do that's adjusting in your favor. The issue with adjustables that people ran into in 2006, 7, and 8 is, so with an adjustable, you've got the index, which is like the LIBOR or Treasury, and then you have a margin. And so your mortgage is probably 2.25% above whatever the LIBOR rate is, which or the Treasury, which puts you somewhere between 3 and 4. Before the crash, all these subprime companies, the way they got people is they did a 2-year ARM, so the rate was fixed for 2 years. But rather than being 2.25% of the Treasury rates after it adjusted, it was like 6.5% above the Treasury rates. So if you have a traditional conventional adjustable, there's caps on what it can change, and because the margin is low, it's most likely not going to increase on you. Some of these subprime loans went from like 5.5% to 10.5% in year 3. And so if you combine that with the person who was getting it, who put no money down, and a real estate market, that was declining in value, it was like the perfect storm. So like every one of those loans went bad because it was 6% above the LIBOR, not 2% above the LIBOR. So, and those companies that did that to people are all bankrupt, like they should be.
Yeah. It's easy to see why we had the 2008 crash when we're looking at, of everything that was going on. Yeah.
Yeah.
Well, if there aren't any other questions, I guess we can call it a day. Thank you so much, Mike, for your time and your knowledge.
Yeah, appreciate you, Amber. Thanks for having me on. We're loving these Zoom meetings. It's our new normal.
It's actually really cool. I think I might start enacting these, even for future use. So,
well, yeah, for the rest of you guys, before Amber and I started, we were joking that I think I think I have like 5 of these today between people on our team and doing this and another client. And yeah, my wife and her friends do like a Zoom happy hour a couple nights a week where they all drink wine at 6 o'clock and, talk with their girl talk and have fun because they can't see each other. So we're all adjusting the best we can, right?
Yes.
Mental health. It keeps your mental health, mental exercise.
Yeah.
Well, thank you all so much for joining us. And thank you again, Mike. I hope you all have a wonderful day and great weekend.
Awesome.
Happy Friday.
Thank you.
Thanks, Amber. Bye-bye.